Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are with us today as we talk about financial matters. Myself and my co-host, we're both practicing financial advisors, and I've been doing this program for a long time. I'm glad you are here with us.
29
talk
years.
About financial markets and take your questions, answer your calls.
29 years have we been doing this? 29 years?
Yes. 29 years.
Wow.
And hopefully another 29.
No.
No, I'm pretty confident on that one. That didn't take long.
Let me think about it.
Anyway, I think all of our listeners are in the United States, and if someone listens overseas, you are an American living overseas. I was talking to a young person. It was starting this little business, worried about things. I'm like, what's the worst that can happen? He's, well, I'm like, this is the United States. Nobody goes hungry here.
That's right. Unless you're addiction or mental illness.
All right, fair.
Give a qualifier.
Okay, all right. He's your normal college graduated kid thinking about starting this business.
And if it doesn't work,
I'm like, this is the time in your life to start something. What?
Yeah, if it doesn't work, go get a job. You tried.
What's the worst that can happen?
Yeah, you tried.
It's a and with self-employment tax, you only pay the self-employment tax if you have income. If you don't have any income, you don't have a self-employment tax. Unlike some other countries around the globe that have a
self-employment tax.
Yeah, you got to pay for all. Anyway, it's.
And what did he take the advice?
I don't know. Probably not. No, I'm just kidding. Yeah, it's funny. So, I'm not going to go down that path.
No. Yeah. Now we're all interested. Now, is it offensive?
No. So, we had an event at our home last night, and a friend that I hadn't seen. I've known this woman for 30 some years. Her son was an intern.
No, I didn't get an invite.
It was on foster awareness to get and trying to encourage people to get more involved in foster youth.
Okay.
Would you have liked an invite?
No. So I'll send a check.
Oh, let me remember that when we have the next fundraiser. Anyway,
I'll send a check if I don't have to.
Her son was an intern with us when he was in college, between his junior and senior year in college. And he was like this really go-getter guy. And after the internship, someone gave me a good report. I said, I don't want to hire him after college. I'm like, well, why not? I said, he's gonna have his own business, and there's no sense us investing in someone for a year or two and then they leave.
Yeah, try to grow them.
And so I talked, what's your son up to? Oh, he's got this great business.
Does he own his own business? Good for him.
And I told her the story, and that I could just tell, like, this guy.
He's not. Some people aren't built to work for other people.
No, that was clearly this guy.
Yeah.
But it's I don't know why I started thinking about how great this country was.
It is.
All these opportunities we have.
It is pretty good.
It is good.
Yeah.
And my apologies for not inviting you at the event. It was quite lovely. We had a catered.
Okay. I'm glad I actually didn't go.
All right, let's take some calls. To join the program, love taking your calls. Questions@moneymatters.com is how you can connect with us. Let's start off with Pete. Pete, you're with Allworth's Money Matters.
Hello, guys.
Hi, Pete.
I'm just curious, without insider information, how do analysts come up with earnings estimates?
Well, companies have entire departments to deal with analysts and press. So the issue is they cannot give information to just one analyst at a time or one person at a time. It's got to be pretty broad. So, for example, they'll have earnings calls, and just about anyone can join an earnings call.
Yes.
You can join an earnings call.
Yes.
So listen to those earnings calls. And so when they distribute information, they need to make it publicly available to everyone at once. Now, it might be that they stick it up on their website somewhere, but yet they have more in-depth conversations with these analysts.
And sometimes they're providing really in-depth guidance, and sometimes they're not. So some companies choose not to actually
provide much guidance at all.
Because they're like, this is getting in the way of us running a good business. So if the stock goes up on a day-to-day basis, who cares, right? Or goes down, no one cares. That's some companies' view. But there's lots of information. One of it is they look at their competitors.
Yeah, oftentimes analysts specialize in industries.
That's right.
So they'll specialize in an industry, so they know the industry really well. They have a pretty good idea of well, they have some idea. They're guessing still in the future.
Yeah.
Have a good idea of what's going on in that industry, who are the players in that industry, what kind of profit margins are in that industry, what's the future outlook.
What happened to cost of goods that are inputs in that industry? They even go as far as using satellite imagery in shopping centers to actually look at how many cars are in the parking lot. So if I'm running a Kohl's, I might, as an analyst, subscribe to a service that actually keeps me up to date of how many cars are in that parking lot of Kohl's at any point in time. And I could take that sales data by taking those numbers and working backwards to try to get to estimates. But they will glean information anywhere they think it's helpful.
Okay. No, I appreciate it. I was just curious how they did that.
Yeah. Why do you care?
He's
I mean,
just
I don't even
curious.
think. I don't even think about analysts.
No, I was just curious.
Yeah.
Yes. So, and some analysts are better than others. But but the dangerous thing about analysts is you'll see some analysts that are actually employed by firms that are underwriting a stock or taking large positions, and they're pumping something that isn't necessarily true.
Pat, I mean, it's not as common as there's a lot of regulations have increased the last 20, 30 years to try to make a level playing field. But to your point, Pat, let's say someone's an analyst for Merrill Lynch.
Okay.
And Merrill Lynch does big business with the company that they are analyzing.
XYZ.
Right? So maybe
they put it, and they
do investment banking business with them.
Or bond underwriting or debt, right? And so let's say, as an example only, Merrill has a buy on that stock. Their analysts say, this is a buy, right?
Now the analysts, I'm sure they're trying to be as objective as they can.
But the structure is such that if they move the stock to a sell or to a hold, that it wouldn't be uncommon for CFO or someone's in the finance
XYZ company to say, "Screw you guys! I'm taking our business elsewhere."
Yeah, what are you doing to me here? You're not helping my stock price. But that's not what he asked. That's just how it works.
It's not supposed to work that way. And any analyst would say, "No, I'm completely objective."
Scott, did we not? Well, thank you for the call anyway, Pete. But Scott, did we not see that the underwriting firms that were rating bonds, Fitch and
that was a while back, yes.
That they were completely
the
manipulated.
problem with a lot of these underwriters, the companies will pay, particularly on the fixed income side.
Underwrite it. Yes,
they pay to get a rating.
Yes, those are the bad things about investing. Is some things are not as visible. And by the way, every time there's a crisis, it gets a little bit better. But at the same time, they do things like allowing companies that are unregistered or people that aren't considered registered investors. There's a name for
accredited investors.
Accredited investors invest in things that they shouldn't. Like this crowdfunding stuff is just crazy. It just makes no sense that I could go out there and get crowdfunding to raise $10 million, right? For a thing that is an igloo cooler with a speaker in it, and all of a sudden I've raised $10 million. Makes no sense. It's just ripe for manipulation and fraud.
Well, I think an analyst role.
I went way off on a rant there.
Yeah, I know. I didn't want to go down that rabbit hole with you. But I was trying to visualize the cooler with the speaker. I don't have one of those, and I'm thinking I need one more thing in my life. And there, I've now discovered the one thing I would like and don't own.
Oh, it's a little thing I'm working on. You'll see me on Shark Tank here in a couple of weeks.
Shark Tank, okay. But I think with the flow of information today, Like, unless here, what are you going to, like, these analysts, what are they doing anymore? Like, most professional managers, investment managers, cannot outperform the own index that they're.
Well, this is an area that they actually think that AI will have a major impact because it's much better at gathering information and distilling it than an analyst is.
And it won't have the same kind of bias that you just brought up.
That right.
It's still a guess on the future.
It is.
But nobody really knows what the future's going to bring.
No one.
And no one knows who's going to be the winners and who's going to be the losers. You know, it's interesting. I was looking at Chevron the other day. I was just reading an article about all the companies that have left California the last decade, right? They were one, and they're a prominent one. And they've been around forever. There was someone who called our program a few years ago that had they had a large position in Chevron. I just remember said, you need to diversify. I don't care what happens to them. But the stock has not done well the last few years. Chevron, as other oil companies have done much better. And it was just one of those reminders to me of, I don't care what the market leader is.
Oh, at any point in time.
The market leader's not going to be the market leader forever.
Ask Intel. Ask any of the railroad companies that were in the Dow.
Which used to comprise 9 of the 11 stocks, right? We're all railroad.
We're all railroad, right? And it's Amazon today or it's NVIDIA, but it will not be that way 20 years from now. It will be a company that we have never heard of.
Well, who heard of NVIDIA 20 years ago?
It was around. It just wasn't that popular. Or Amazon.
Yeah. It's just one of those things I think people need to be cognizant of.
Keep reminding yourself.
Yeah. All right, let's continue on. We're talking with Jerry. Jerry, you're with Allworth's Money Matters.
Good morning.
Hello, Jerry.
How are you guys?
Good. Not as good as you. Not as much
know.
energy as you. But we'll get by. What can we do to help?
Good. Well, I have a question. I'm here in California, and I have a son, and I have rental properties, and I want to know what's the best way when I transition and he gets this rental property for him to either avoid or minimize inheritance tax.
Okay. Well, let's talk about the rules today.
Yeah, when are you going to die?
Correct.
If it's soon, we're pretty clear.
Yes.
I'm 65. I'm negotiating right now with the guy upstairs for 20 more years right now.
Okay.
All right,
We're in negotiations with that right now.
Odds are you have a long time to go.
And the reason we say that almost flippantly is because the estate exemption amount, the amount that exempt from tax, expires at the end of 2025. The current number expires at the end of 2025. And it goes back down to about 6 million.
About 6 million.
And right now it's about 14 million per person.
Wow.
About that. But it was only a temporary, which is the way Congress uses these things when they do tax cuts that
increase the deficit.
They don't make them permanent, and that way they can get away with it. But it depends on who ends up in office next year and what the makeup of our political system looks like.
Yeah, because right now it's currently set to expire, the 14 million, which is an index for inflation, why you said it's about. That will revert back to a previous number, which is 5 million. That's indexed for inflation, so it's going to be roughly 6 million today. But there's also proposals. I just read one yesterday with a chance that they're going to start taxing the gain, unrealized gain on inheritance for estates above some value.
Oh, gosh.
Which, by the way, makes perfect sense to me.
What do you mean it makes sense to you?
That either you have the capital gain or the exemption, but not both.
Oh, okay.
You mean from a rational standpoint?
Correct. From a purely rational.
A purely rational standpoint would take out the rate of inflation on a capital gain and only tax you on a true gain.
Okay, all right. We could do a whole program on rational. But thank you, Scott. That makes sense because otherwise
you increase inflation and suddenly the debt's much less, and also you get higher tax revenues off capital gains.
So, but that's let's just answer your question, Jerry.
Yeah,
What are the
yeah.
values? What is the value of these rentals?
Right now, probably about $3 million.
Okay,
Right now.
so under current tax code, if you die, you receive. Are you married?
No.
Okay. If you die, you receive a step up in basis.
Your son does.
Correct.
Okay.
Your son, which means there's no taxes.
Just like he paid $3 million for these properties.
And there's no taxes. So I'll give you an example where this is really kind of important. I was bicycle riding with a friend of mine, and his father.
Pat's showing off two things. One, that he's exercising,
And
right,
two,
and two, that he is a friend.
That's great. Yes, great.
I should say I was bicycle riding with my friend, a singular, and his father's in his late 80s and has a bunch of rental properties in the San Francisco Bay Area that he has collected over the years.
And it's worth quite a bit now.
Worth a lot of money. And so
Wouldn't have been so much if it was in Detroit.
yes, it just happened to be that they're in the Bay Area.
Right.
Because this is where this Greek immigrant landed in the U.S.
Great.
So
Good for him.
No kidding. And by the way, he said, if you talk to my dad, you'd think he was the poorest man you ever met, which is like exactly. So he was
They're like me. I don't buy anything. I just leave it all for
That's
him.
why-
Yeah.
right. That's why you have money. So we talked about it, and I said, he's talking about selling them. I'm like, you've got to really sit down and think about this.
Because selling them.
Because when the minute
capital gain.
the capital gains, but then he's talking about fire insurance and these things, and I'm like, well, maybe you do a structured sale to someone so that you can recognize some of the gain, push it off. There's all these kinds of different things.
Balloon payment.
Correct.
Triggered at his death.
Correct.
I don't know if you
right?
can quite do that, but yeah, you can structure something.
Correct. But so in your situation right now, if you plan on holding these to death, don't worry about it.
Okay.
Now, under Prop 13, what we would expect, because they're rentals, under Prop 13 in the state of California, that there will be an increase in property taxes on this.
Okay. Okay. So that is expected. Okay.
And is your goal here is to make sure that your son has money in retirement, or what is? Because you're relatively young. To say I'm 65, and I want to make sure your number one objective is to make sure he doesn't pay capital gain taxes on these, and you're asking God for 25 more years. So
Right. So, and my goal is
you'll be
really
90. How old will he be?
He's 28 right now.
Okay, he's still relatively young.
So, yeah, totally relatively young. So I'm trying to ensure that he won't lose anything if he has to pay a whole lot of money out. That's what I'm trying to.
Okay, well, you're under.
I wouldn't do any other advanced planning than having just a basic living trust set up.
That's right.
If I were
That's
you.
what I have, and I have that right now.
Because you can, if you transfer these into some sort of irrevocable trust to try to preserve this exemption for the fear that it's going to go below $3 million, then whatever gain happens going forward, that will be.
It happens in his.
Actually, the cost base is going to transfer over to the trust, and all that gain would be taxed one day.
So under current tax law, you're perfect.
Yeah.
Okay.
But we're not attorneys, so consulted.
Yes.
Okay. And what kind of an attorney? Like a tax attorney?
Estate planning.
Estate planning. But
Estate
you have
planning
you have a trust, correct?
I have a trust.
How up to date
have
is
a
the trust?
I just updated it about 4 months ago.
You don't need to do anything.
Yeah.
You're perfect.
Why didn't your attorney have these conversations with you at that time?
Somewhat, but not a lot.
Okay.
Oh, all right.
Mm-hmm.
No,
Yeah.
you're fine.
A good attorney usually talks through these things, trying to figure out what you're trying to accomplish.
I'm just going to say no. How about that?
That's
Okay.
all.
No, you're
all
fine.
you need is a basic trust. at this point.
Call us back in
25
January.
years.
No, call us back January of 2020. Call us in January of 2026, God willing.
That's what I'm going to do. That's what I'm going to do. I'm going to reach out to you guys for sure.
All
Okay.
right.
All right.
Thanks,
Appreciate
Jerry.
the call.
Appreciate the call.
All right. Thank you.
Let's talk now with Michael. Michael, you're with Allworth Money Matters.
Thank you. Glad to hear from you.
Thank you.
My question is kind of short and simple, I think. I'm going to turn 70 in January, like 4 months from now. And my SSA.gov tells me that my payment will be $4,977 at 70 years old.
Okay.
And the maximum for Social Security is $4,873. So my question is, how does that work? Should I be applying for it right now instead of waiting for another 4 months since I'm already past the maximum?
You haven't. So, Pat, what is the maximum at full retirement age today? I don't know the number off the top of my head.
I don't know.
4873, 4,000.
That's for normal retirement age.
No, that's for 70 years old.
I don't know the answer to this. If in fact what you are saying is true, then you should take it today.
Yeah, that's what I'm wondering.
Yes. But I don't know whether it's true or not.
Or if one has factored in an inflation adjustment and the other one has not yet.
That
would
the
be
other thing.
That
yes.
would be my guess.
But do you need the money?
No,
What's your overall net worth?
about 25 million.
Okay. And this is a different side. Take it now. You should have taken it a couple years ago. And the reason is,
Well, we don't know. It's irrelevant now.
A couple years ago either.
well, but my fear is that we've talked about
Yeah,
this.
but
on the
we're
show,
not going to talk about it again.
is legislative risk.
If
I'd take it.
All right.
And how much is your income?
Just about $1.1 million a year.
Are you married
Yes.
and children?
All in their 40s.
I assume that your trust is up to date.
Never had one.
Okay, so look. Okay, Michael,
Yes.
you need to do a number of things, right? So if this $25 million is a real number, which I believe it to be, then you should be worried about the
estate tax
exclusion reverting back. In fact, I would make the argument that you should contact an estate planning attorney today. And are you gifting money to these children?
Yes.
How much are you gifting a year?
I think it's $18,000 for this year. A person.
And you and your spouse are gifting to each one of the children and or their spouses
Yes.
and their grandchildren?
No, not the grandchildren.
And is your plan, let's say if you and your wife both passed away today, is the plan for all these assets to go to your family? Do you plan on having it all go to charity? What would your hope be?
No, I've been giving to charity all along. It would go to the family.
Okay.
So,
So there's a major tax change that could, well, it's structured now. I think we'll have a little more clarity after the election.
Yeah.
It's $25 million, Scott. He's so
there's
close
some
to
planning.
the exclusion.
There's some good planning.
So the answer to the question is take the Social Security today. Take all of that money that you're getting in Social Security and give it to an estate planning attorney to actually do the real work. It's going to cost you 10 or 15, 20 grand
for a good estate
planning attorney.
Yeah.
But there's a number of things you can do. If your goal is to make sure that this $25 million gets past your children, the estate exemption is currently about $14 million per. So you're fine if both you and your wife died today. But that's set to expire at the end of 2025, which is just
right.
and revert back to $6 million
A person, so that's $12 million.
Anything above that's going to be taxed at roughly 50%.
So the planning you should be doing is to actually figure out what assets you should be getting out of your estate while this estate exemption is high. This is what you should be doing. If you were at 10 million, I'd say, it doesn't matter. 15 million, But anything over $20 million, you need to be aggressive about it right now. Right? And look, I had a conversation with my little brother last night who called. One of their neighbors is suffering from Alzheimer's, and it's progressing really quick. He said to me, well, they need an attorney that will come to their home, and how much do they charge? And I said, you probably don't want an attorney that would come to their house unless they have an existing relationship with the attorney. And you probably shouldn't be worrying about getting the cheapest attorney.
That's correct.
Right?
I agree with that.
Okay. But I'm glad you called. I am so glad you called because of the Social Security. You need to take the Social Security, but if you have this money for a reason. I'm sure you weren't born with $25 million.
No, sir. Born with zero.
That's right. And I'm sure you didn't inherit this, did you?
Have not. My parents are still alive.
Okay.
Wow.
That's so Are you named as a beneficiary in their estate?
My dad is one who will not talk about any of that, so I really have no idea.
Yeah.
He's 94 and my mom's 92.
Your estate planning, if they have any
You
net
probably
worth,
don't want to take any.
you might not want to take any. So,
Which means either you have a conversation with your parents now or you disclaim.
right? So the first step is disclaim. The first step for you to do is, and I wouldn't wait. I mean, I would not wait. And the reason I wouldn't wait is because the attorneys are waiting because they know that an estate planning attorney is going to be so busy next year, you will not be able to find a decent one. They just, because of this change. And
Well,
it
it's
depends
two
on
issues.
who goes to.
It's not just estate. I think the real bottleneck is going to be in appraisers, whether it's property or businesses. Like you've got a family business and you're transferring 40% of the stock to your children. What's that valued at? Well, you need to get an appraiser. And
Excellent point, Scott.
Yeah, I
didn't even think about that. Yeah, so take the Social Security now and do the trust work.
Yeah, I'm glad you called, Michael. Wish you well.
I'm glad he called too.
Yeah.
Isn't it? It's a weird thing when people call and say, "I've got
Oftentimes it's a question.
they never ask about.
Well, the question was not even around the edges. I mean, there was not even an edge there, right? Like 3 or 4 months, and he just wants. I mean, the reason he's got the $25 million, he's been very frugal over the years and wants to maximize every penny.
Yes, you could tell in the nature of the call.
And our concern is, you might be paying millions of dollars in estate taxes that you can avoid if you do some planning.
That's right.
Yeah,
and especially with a gentleman like him. You know that you could move $10 million out of his estate, and he'll suffer because he's afraid he's going to run out of money, but his lifestyle won't suffer.
absolutely. Yeah. Well, Pat, a few weeks back we had a caller reach out to the show and asked about buffered ETFs.
Yes,
and we got a couple responses, both internally and externally, like, "Hey guys, like you didn't give us a very complete answer, and you sounded a little negative on them."
and we do use them
Yes,
as a
we're
firm.
a little more agnostic on them.
Yes.
And so I thought, why don't we have our resident expert come talk about it? So Victoria Bogner is she's got lots of different.
Wait, Scott. So once again, we fell short. That's what I'm hearing.
I hear it in the morning when I first get up for my family.
I come to work, and then due to this communication thing called email throughout the day.
Anyway, Victoria Bogner has joined us. Hi, Victoria. Thanks for taking a few moments. And Victoria serves on our investment committee. She's also a chartered financial analyst, a certified financial planner, and et cetera. I would say you're like the resident expert of our roughly 500 folks or so at Allworth on buffered ETFs. So maybe if you can describe briefly how they work, and then secondly, how they're used in strategies, and what are the kind of ideal circumstances where they're appropriate.
Sure. So buffer ETFs, they're relatively new on the scene. They really started up in about June 2018. So we've seen them through several market cycles at this point. But they're a type of liquid investment that's designed to provide investors with some downside protection while still offering some level of participation in market gains. So these types of funds, they typically cap the upside potential while providing a buffer against a specified percentage of losses. So for example, an ETF might protect against the first 15% of losses in the market, but in return for that downside protection, your gains are capped beyond a certain percentage. And they're able to do this by using another type of investment called options. And that allows for that balance between risk and return.
And so essentially all they've done is taken a strategy that's been around for years and years and years, which is a collaring option to collar the risk, and they've institutionalized it and made it available to the mass investor. Fair statement?
Exactly. And it used to be that investors really could only access this through either indexed annuities or structured notes, neither of which are liquid. So this presents a really unique opportunity to invest in the space and still be able to move out of the strategy if something occurs and the investor wants to pivot to doing something different.
And how often do you see a client put 100% of their investments in buffered ETFs?
Generally, you don't put 100% in buffer ETFs. I mean, they're essentially a middle ground between full market exposure and the safety of more conservative investments. Typically, we see 30% being invested in a buffer ETF strategy because that's enough to offer downside protection for the entire portfolio without putting too much of a cap on the upside potential of the portfolio. So they're useful for more risk-averse investors, those nearing retirement, others that want to stay invested in the market, but they're concerned about volatility. We have the election coming up, so people are thinking, do I really want to invest in this kind of market? Of course, we all know as professionals, you can't time the market, so this allows investors to participate in what market growth there still is there while limiting the potential losses they might face during downturns.
So let's walk through the mechanics if we could real quickly. So it's buffered. It's not offering 100% downside protection. So if I've got a buffered ETF and using the example, you can use them at 10%, 15%, 20%, whatever the number is. But let's use the 15% that you – so let's say I have buffered ETF in the S&P 500. Once it hits the 15%, so let's say the market, let's say the market falls, the S&P 500 falls 30%.
You put $1 million in it.
What does my portfolio look like at the end of that?
Sure. So this is targeting a rolling 12-month period generally. That's what these buffer ETFs are covering. So if you were in the S&P 500 in 2022, great example, stock market fell by 20% by the end of the year. The S&P 500 was down 19.44%. Our buffer ETF strategy was down 4.5%. So at the end of that 12-month period, we were able to buffer 15% of that loss. And if you remember, bonds were also completely trampled in 2022. So they offered no diversification against risk. So these buffer ETFs really offer more diversification in the portfolio beyond just your traditional equities and bonds.
Okay, so let's do the opposite. So the market's up, right? Because there's a cost to everything. There's no free lunch.
Absolutely.
Unless you go to an index annuity seminar, in which case you'll get a free lunch. But there's a cost to that.
Your lifetime savings locked up for the next decade.
And you have to sit through that presentation. So let's say the market's up 30% on the S&P 500. What kind of returns would I expect on my buffered ETF S&P 500 15%?
You're right. There is no free lunch. So at being able to have the downside risk mitigated, you're capping yourself on the upside. However, we have an actual buffer ETF strategy here at Allworth. And what we do is we make tactical trades to adjust the portfolio in response to market conditions. So if you're in a buffer ETF and it's close to reaching its cap, so let's say you're in an S&P 500 buffer ETF, the cap is 15%. The market has gone up 15%. So that buffer ETF is up, say, 10% at that moment in time. We can sell that ETF to capture that gain and buy a fresh buffer ETF with a higher cap. So that's the beauty of doing a more tactical strategy around these and the power of their liquidity. We're able to lock step in a rising market to reset those caps and buffers as we go. So our goal really is to be able to provide better risk-adjusted returns than just your typical 60-40 portfolio. So we're trying to do better on the upside than a moderate portfolio and mitigate more downside risk at the same time.
So if I'm an aggressive investor, am I interested in these?
No. If you're an aggressive investor, you want to get all the reward for all.
Or a younger investor.
Or a younger investor,
yes.
right?
Someone with a long time horizon.
This is really more appropriate for those risk-adverse investors that maybe they're in cash, but they really shouldn't be. They're afraid of investing at high stock market valuations. They're very emotional. This helps with peace of mind. It takes the emotion out of decision making. It makes your ride in the market much more 45 miles an hour. But there are those young, aggressive investors that want to go 80 miles an hour, and this isn't the right strategy for them.
If I had a choice, would I do it in an IRA or outside of an IRA?
Definitely an IRA if you're using the Allworth strategy, because since we're buying and selling these ETFs as we go along throughout the year, we're generating a lot of capital gains, which is good. If you have gains and you're paying taxes, that means you made money. But ideally, you want to do this in a tax-deferred or a tax-free account like a Roth or an IRA.
If you have that option available.
If you have that option.
Yes.
Mm-hmm.
Awesome.
And Victoria, so just for the listeners, tell us how you joined Allworth, because I got to tell you, the first time I met you, I was like, "Wow, we need to work with this person." So, how did you join Allworth? And where's your office? And what do you do with Allworth? I'm kind of curious myself.
Yeah, how did that
You have
happen?
1 kid or 5? I forget.
My firm joined Allworth in April of 2023. So I was the CEO of a firm here in Lawrence, Kansas, called McDaniel Knudsen Financial Partners. And we had gotten to that point where we needed to reach that next level. We had maxed out our capacity. So we were either going to have to hire a bunch more people to get to that next level or join a firm that had already invented that wheel. So either we were going to have to reinvent our own wheel or just bolt on to somebody else's wheel. And when we learned about Allworth and the culture and how they really care about clients and put them first, we knew that was who we wanted to hitch our wagon to. So we decided to join Allworth last year. It has been a wonderful experience. I joined the investment committee, and I'm also in charge of client experience here at Allworth, which has been a fun role.
Awesome.
And thank you for joining us. I remember sitting in the conference room having conversations with your firm, and I'm like, let's just see how good we can work together. And it has it's exceeded my expectations. So thank you. Thanks to your whole team out there, Lawrence.
Oh, absolutely. We appreciate all of you as well.
Yeah, thanks for joining us today, Victoria. Appreciate it. It's interesting, Pat. I think for our growth, for the company's growth, our number one objective is to serve our existing clients. And one of the things I love about our fee-based model, it aligns our interest to our existing clients. That's our number one goal, serve our existing clients. But as an organization, we want to continue to grow. There's a lot of people out there. And we found the best way to get talent is through these mergers of finding other firms, smaller firms, and having them merge in with us, because they're people that aren't out looking for a job. Victoria certainly wasn't looking for a job.
No, she was the CEO of a quite a successful firm to begin with.
Yes. And so, but it's been a phenomenal way for us to get talent.
Oh,
it
yes,
really is.
yes,
with some of our best advisors.
Yeah. And they hit growth levels that were hard to overcome. And fortunately, we were at that space and it's additive every time. Most of the time. I shouldn't say every time. Most of the time.
Yeah. Hey, before we don't really, we're not going to take another call today.
Yeah. But before this show, Scott and I normally have a conversation like, what should we talk about? And seriously, it's like, what do you want to talk about? And it's September, and this is almost October. It is where you should actually start leaning into your year-end plan.
For sure.
All right. Roth conversions.
I I sent a detailed letter to my CPA email just 2 weeks ago
saying
on these things, because I've got 1 quarter left in the year. I had some tax questions because once December 31st is gone,
too late.
Yeah. So there are things like, are you maximizing your HSA? I did a little audit on myself a couple weeks ago.
Your 401k. How'd you do, by the way?
I hadn't adjusted my HSA for the higher limits for this year. And so I had about $1,000 I needed to make up.
Oh, very good.
But once December 31st is gone, you lose those opportunities. Yeah. So are you maximizing your 401k? Are you maximizing your HSA? Do we need to, is there a Roth conversion that we need to consider?
Should I harvest some losses now Should I wait till the end of the year? Should I do both? Probably both.
Probably both. I mean, there's some other things to consider tax-wise.
If you're gifting, it takes place in the calendar year, right?
Because invariably, Pat, we talk to people the following year and they miss opportunities.
All the time.
One of them that if you're self-employed and have no employees, you can set up a solo K plan, super easy to set up. Think of it like a private 401k without all the regulatory burdens that come with this.
Super easy.
And you've got until the time you file your taxes to fund it next year. So you can establish this, and you can put a ton of money into these solo Ks. You can put, about $60,000 and something like that.
Yes, dependent upon your income.
Yeah, dependent. But you can put 100% of your income up to $60,000, either pre-tax or Roth solo K.
Or both.
Or to the maximum dollar amount.
That's right.
But you have to have them set up by December 31st. If you don't have it set up in this calendar year, you can't. But if you set it up, you've got until October 15th of next year to fund it.
But even then, you don't have to fund it by October. If you don't have the money, you just don't fund it.
That's correct. Yes. But
it's easy.
There's just a number of things that need to be.
So take a couple minutes, look at your situation. Those are a few ideas, or circle back with your
financial advisor. Hopefully, you have a somewhat decent tax preparer.
Hopefully.
Or you know what you're doing when you're filing your taxes.
Yes. And before we go, as always, if you would be so kind as to leave a review or a rating on our podcast.
Yeah, we would appreciate it.
Appropriate vehicle.
Yeah. Thanks for joining us. It's been Scott Hansen and Pat McClain of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.